What if the greatest financial disaster of our lifetime isn't coming in the distant future, but is already quietly unfolding beneath our feet? What if every chart, every banking report, every macroeconomic signal is whispering the same message that the world ignored in 1929 and again in 2008? And what if, for the first time in history, all three pillars of modern wealth stocks, real estate, and bonds are cracking at the same moment? Most people believe we're facing something new, but we aren't. We are reliving the same patterns that haunted previous generations, except this time, the tools that once saved us are exhausted, blunt, and almost powerless. To understand where we're heading, we must first understand the ghosts of past collapses, a century of warning shots. In 1929, the collapse wasn't just a market event, it was the psychological shattering of an entire nation. Stocks fell 89% over 3 brutal years, unemployment hit 25%, and thousands of banks vanished with the savings of ordinary people. It took 25 years for American markets to crawl back to their old highs. A generation lost not just money, but trust. Then, almost 80 years later, the world watched a different bubble burst. 2008, a housing-driven meltdown that infected the global economy. Stocks fell 57% in mere months, millions lost their homes, and governments were forced into unprecedented bailouts. Only after 5 long years did markets fully recover. These crises were devastating, yet they were simple compared to the structure we're living in today. Back then, it was one bubble at a time, one spark, one collapse, one solution. 2025 breaks all those rules, because now, according to financial historians, we are in the first true everything bubble, an event where every major asset class inflates together and therefore must eventually fall together. And when everything falls together, there is no safe harbor. This is the brutal logic of mathematics, not speculation. We are not in 2025, we are in 1928. Many people think we're at the beginning of a new chapter, but the uncomfortable truth is that we're near the end of an old one. In 1928, 1 year before the Great Depression, elite investors bragged about a new era of prosperity. Stock valuations were absurd, leverage was everywhere, and new technology, cars, radios, electricity, convinced the public that risk had disappeared. The United States today feels eerily similar. We tell ourselves AI guarantees endless growth, just as they once believed the automobile guaranteed endless prosperity. We repeat, this time is different, just as casually as they did, unaware that this phrase has appeared before every major crash in modern history. But the most dangerous similarity isn't psychological, it's mathematical. Just like 1928, we are living with extreme valuations, extreme leverage, extreme inequality, and extreme speculation. But unlike 1928, our central bank doesn't have the tools to soften a collapse. Back then, the Fed still had space to cut rates. In 2008, they slashed from 5.25% to 0% and printed trillions to save the financial system. In 2025, those tools are already spent. Interest rates are already near cyclical lows. The Fed already printed trillions, causing the worst inflation in 40 years. The government already carries $36 trillion in debt, restricting its ability to borrow more. The tools that saved us in 1929 and 2008 are now unusable. This is why economists say 2025 isn't just another recession. It's the first collapse where the firefighters have no water left. The 3 bubbles that should never exist together. To understand why 2025 is unlike any crisis before it, we must examine the 3 bubbles converging into a single point. 1. The stock market bubble, concentrated fragility. The S&P 500 trades at a P/E ratio of 28, nearly double its historical average. This extreme level has appeared only twice before: 1929, months before the Great Depression; 2000 Wasson, months before the dot-com implosion. But today's danger is magnified by concentration: 7 companies. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla now make up 30% of the entire stock market. This has only happened once before, 1929, when a handful of industrial giants carried the entire market on their backs. We all know how that ended. If even one of the magnificent seven stumbles, it drags the entire US market with it. And the biggest symbol of fragility is Nvidia, a company priced at 65 times earnings, valued higher than the entire German stock market. AI may change the world, but bubble psychology hasn't changed since 1999. 2. The real estate bubble, bigger than 2008, housing prices in late 2025 sit 50% above historical norms compared to income. In 2008, the bubble was 35% above trend, meaning today's overvaluation is 43% larger than the bubble that nearly shattered global capitalism. And commercial real estate is collapsing even faster. 45% of U.S. office space is empty San Francisco offices. 35% vacancy mortgages written at 3% are now being refinanced at 7 or 9%. When financing costs triple, buildings become financially unviable. Defaults rise, banks take losses. This is 2008, but instead of subprime residential loans, it's happening in commercial real estate. 3. The bond bubble, the unthinkable crash. The bond market is the foundation of the global financial system. In every crisis before, bonds acted as a safe haven. But now bonds are crashing with stocks, something that did not happen in 1929 or 2008. The reason? U.S. government debt exceeds $36 trillion. Debt is 125% of GDP, similar to WO2 levels. Annual interest payments now exceed $1.2 trillion, more than the entire defense budget. When interest payments become the largest expense of the state, the government has only three options: cut spending, recession raise taxes, recession print money, inflation collapse. Every path leads to crisis. There is no painless exit. A repeat of history, but amplified. Every major indicator in 2025 mirrors 1929 with uncanny precision. Extreme valuations, extreme leverage, extreme inequality, blind faith in new technology, a belief that this time is different. But here is the terrifying difference. In 1929, only 10% of Americans owned stocks. In 2025, nearly 60% do. When the market collapses this time, it will not just hit Wall Street. It will hit retirees, families, and ordinary workers on day one. Every safety net that saved previous generations, cheap credit, money printing, bailouts, is already torn apart. And the true cascade hasn't even begun. Because what comes next is the pattern that history repeats with brutal consistency: a transition from slow cracks to sudden collapse. And that collapse begins sooner than most people believe. If the stock market bubble resembles 1929 and the housing bubble resembles 2008, then the third bubble, the bond bubble, is something humanity has never confronted. It is the mathematical breaking point that neither Roosevelt nor Bernanke ever had to face, and it sets the stage for a collapse that is bigger, faster, and more synchronized than anything in the historical record. But to understand the mechanics of the coming crash, you must understand the hidden infrastructure underneath the economy: leverage, derivatives, inequality, and systemic risk, all of which are now stretched to extremes not seen in any previous era. The leverage monster: bigger, faster, invisible. In 1929, speculation was visible. Ordinary Americans borrowed money from brokers, margin loans, and used them to buy stocks. In 2025, leverage is everywhere, but almost none of it is visible. Margin debt is high, yes, near 1929 levels relative to GDP, but modern leverage hides inside. Options contracts, credit derivatives, corporate balance sheets, structured financial products, and even consumer credit lines. People today borrow on credit cards to buy stocks. Corporations borrow billions to buy back their own shares. Retail investors trade options at volumes that didn't exist 20 years ago. This is not a single bubble. It is a network of interconnected obligations, the same structure that caused the rapid, uncontrollable implosion of long-term capital management in 1998. Except this time, it's the entire economy built on that fragile architecture. And the most dangerous aspect? Unlike 2008, the leverage is not restricted to housing. It is everywhere. Every sector, every institution, every consumer, every government. When one part breaks, it drags the rest down with it. Wealth inequality, the silent accelerant. In 1929, the top 1% controlled about 25% of national wealth. That concentration fueled both the boom and the violent collapse. In 2025, the imbalance is even worse. The top 1% now controls 32% of all wealth. The top 10% drives 70% of consumer spending. When the wealthy stop spending, the economy loses its engine. This is the same structural fragility that helped turn the 1920s boom into the 1930s depression. Except now, the inequality is larger, the stakes are higher, and the dependency is deeper. In the 1930s, most Americans didn't own stocks. So when the market crashed, many weren't affected directly. But today, nearly 60% of households own stocks through 401ks and retirement accounts. In 1929, the collapse spread slowly. In 2025, it will strike instantly. The illusion of safety, FDIC, and the false comfort of insurance. Many Americans trust that their deposits are safe because of FDIC insurance, but that security is an illusion. FDIC fund, $125 billion total insured deposits, $10 trillion. If multiple regional banks fail, as they did in 2023 with Silicon Valley Bank, Signature Bank, and First Republic, the fund evaporates in days. During calm times, FDIC feels like protection. During crisis times, it is a spark in a forest fire. To cover depositors, the government would need to print trillions. And printing trillions in an inflationary environment is how currencies die. This is the exact trap that Weimar Germany fell into in the early 1920s. Not because they wanted inflation, but because the mathematics of debt forced them into the printing press. America is not Weimar Germany, but mathematics does not care about national pride. 2008 versus 2020. Why this time is systemically worse? When the 2008 crisis hit, the U.S. government still had weapons. Interest rates at 5.25% low, inflation moderate, national debt, a relatively strong banking system. China and Europe willing to support global demand. In 2025, none of those lifelines exist. Rates are already low. Limiting cuts, inflation is still elevated. National debt is at wartime levels. Banks are stretched thin by commercial real estate losses. China and Europe face their own crises. In 2008, the government could borrow $2 trillion to stabilize the system. Today, with debt at 125% of GDP, the government cannot borrow another $2 trillion without triggering a bond market revolt. The bailout button is gone. And to make matters worse, China cannot save the world. This time in 2008, China launched the biggest stimulus program in world history, building cities, factories, highways, pulling commodities and global demand upward. But in 2025, China itself is destabilizing. Its real estate sector is collapsing. Local government debt exceeds $13 trillion. Population is shrinking. Manufacturing is slowing. Youth unemployment is soaring. Europe, historically the second engine of global growth, is fighting. Energy shortages, demographic decline, political fragmentation, stagnating growth. There is no global economic anchor to catch a falling United States. The yield curve, the one signal that has never been wrong for 70 years, the inverted yield curve has predicted every recession with zero false alarms. Not one error. It inverted in July 2022 and stayed inverted for 27 months, finally normalizing in September 2024. The historical pattern is clear. Recessions begin 3 or 12 months after the inversion ends, never during the inversion itself, which means the danger window is October 2024, September 2025, and we are inside that window right now. This is not doom commentary. It is literal statistical history. Consumer stress, the breaking point of the American household. Americans today carry debt burdens that dwarf those of 2008. Credit card debt, $14 trillion average credit card, APR, 28% delinquencies, highest since 2011 consumer spending, 68% of U.S. GDP. When consumers hit their borrowing limit, the economy's engine stalls. And we are already there. Auto loan delinquencies have risen to levels not seen since 2008. 7.5% of auto borrowers are 90 days past due monthly payments, 740 plus loan terms. 7 years, these loans were designed to hide subprime lending behind glossy, affordable payments. But the reality is unavoidable. People cannot repay them. Defaults lead to repossessions. Repossessions lead to job loss. Job loss leads to recession. This is how consumer sector collapses begin, quietly at first, brutally in the end. Commercial real estate, the slow-motion implosion. Even before recession hits, commercial buildings across America are already underwater. Financing written at 3%, refinancing now at 7 to 9% occupancy, down 35-45% property values, down 40-60%. More than $2 trillion in commercial mortgages must be refinanced in 2025-2026. These buildings cannot support triple interest payments. Defaults will accelerate quarter by quarter. And regional banks, which hold most of these loans, will be the first to fall. The failures of Silicon Valley Bank and First Republic were not isolated events. They were the opening credits. The real movie hasn't begun. The stage is set. Every indicator, macro, micro, historical, structural, is converging toward the same conclusion. We are entering the most dangerous financial window since the invention of the modern central bank. The entire system has become a tower of overvalued assets, fragile leverage, exhausted tools, and interconnected risks. All it needs is a trigger, and that trigger is coming soon, because the next phase of collapse begins the same way every historic crash begins, with a single crack in the strongest pillar, and one company, one stock, one earnings call, may be the spark that ignites everything. People imagine crashes begin with fireworks, some dramatic headline, some unmistakable catastrophe. But history tells a different story. Every major market collapse from 1929 to 2008 started with something that looked small, manageable, even forgettable. A disappointing earnings call, a single bank failure, a geopolitical spark in a place most Americans can't find on a map. Crashes don't start loudly, they start silently. And by the time the public notices, the cascade is already irreversible. 2025-26 will follow the same script, except faster, because the weakest point in the system is also the most fragile, a market held up by a handful of mega-cap technology stocks. And the first domino is likely to fall from where almost no one expects, from the companies we believe are invincible. The moment the Magnificent Seven break. Imagine this scenario, not an exaggeration, but a statistically common pattern observed dozens of times in financial history. NVIDIA reports earnings. Wall Street expects perfection, double-digit revenue growth, explosive AI demand, massive margin expansion. But instead, NVIDIA gives slightly weaker forward guidance. Not a collapse, not a disaster, just less than perfect. In a normal market, that would trigger a modest pullback. But in a bubble market, perfection is already priced in. Anything less is interpreted as catastrophe. Algorithms, not humans, react instantly. Sell orders flood the system within milliseconds. NVIDIA drops 10-15% in a single day. Because NVIDIA alone represents 7% of the entire S&P 500, this drop automatically pulls the whole index down, even before the emotional panic begins. But the psychological impact is far bigger. If the crown jewel of AI is cracking, what about Microsoft? What about Apple? Amazon? Google? Meta? Tesla? Within hours, the Magnificent Seven bleed together in sympathy. Within days, the market is down 6 to 9%. And this is where the real crash mechanics begin. Margin calls, the accelerant of doom. In 1929, margin calls transformed a normal correction into an 89% collapse. In 2025, margin debt as a share of market value is eerily similar, but with an even more dangerous twist. Modern investors use options, leveraged ETFs, credit lines, and collateralized loans intertwined across trading platforms. When prices fall, brokers demand more collateral. Investors can't provide it. Brokers sell stocks automatically. Prices fall further. More margin calls, more selling. Repeat. This is not human panic. This is automated liquidation. A market built on borrowed money unravels at the speed of software. Institutional risk controls. Forced selling at scale. The most devastating selling is not emotional selling from the public. It is the cold, robotic selling from institutional risk algorithms, pension funds, managing trillions in retirement savings endowments, sovereign wealth funds, insurance companies. These institutions must sell when losses exceed certain thresholds, regardless of economic fundamentals. When markets fall 20%, institutional models automatically reduce equity exposure to protect capital. This institutional selling is magnitudes larger than retail panic, and when it begins, it accelerates everything. Liquidity evaporates, spreads widen, volatility spikes, credit markets freeze. A correction becomes a crash. A crash becomes a crisis, from stocks to bonds. The doom loop begins. The next stage in a systemic crash appears counterintuitive. In previous collapses, investors fled stocks and bought government bonds, pushing yields down and stabilizing the system. But in 2025, the bond market is the epicenter of the crisis. When stock investors flee to safety, the government simultaneously needs to issue even more bonds to refinance old debt and cover deficits. This creates an unprecedented collision. Capital fleeing stocks, buying bonds, government issuing massive new bonds at the same time. The result? Interest rates jump higher, not lower. Higher interest rates mean higher mortgage rates, lower home prices, higher government interest payments, more defaults, more borrowing needs, which pushes bond yields even higher. This feedback loop is mathematically unstoppable once it begins. Economists call it the sovereign debt doom loop. Developing countries fall into this trap regularly. Major economies almost never do. But 2025 is not a normal year. The housing freeze, the silent parallel crash. As stocks collapse and interest rates spike, the housing market enters its own quiet death spiral. Housing markets do not crash violently like stocks. They freeze. Here's how the freeze unfolds. Buyers vanish overnight. Mortgage rates become unaffordable. Sellers refuse to lower prices. Denial phase. Properties sit unsold for months. Sellers needing cash, job loss, relocation, divorce, begin slashing prices. New low sales reset market comps. Banks revise property valuations downward. Homeowners lose equity, become underwater. Defaults begin. What took years to unfold in 2008 will unfold faster now, because valuations entering 2025 are 50% above long-term trends, higher than the 2008 peak. A 30–50% crash is not extreme. It is regression to the mean. Commercial real estate, the detonation point. If residential real estate freezes quietly, commercial real estate explodes loudly. More than $2 trillion in commercial mortgages come due in 2025–2026. But refinancing costs have tripled. Picture this. A building financed at 3% must now refinance at 8%. The interest expense doubles or triples. The property's cash flow collapses. It can't service its debt. The owner hands the keys back to the lender. This is not speculation, it is arithmetic. And who holds most of these commercial mortgages? Regional banks. In 2023, Silicon Valley Bank, Signature Bank, and First Republic collapsed without a recession. In a recession, dozens more will fall. When regional banks fail, FDIC insurance is exhausted depositors. Panic bank runs begin. The government must backstop deposits. Backstopping deposits requires printing money. Printing money destroys currency value. Every step reinforces the next. This is how localized failures become systemic crises. Employment. The last domino to fall before every major recession, unemployment rises slowly, almost invisibly, before accelerating sharply. In early 2023, unemployment was 3.4%. By late 2025, it is already over 4%. It sounds small, but the SOM rule, one of the most reliable recession indicators ever developed, states, when unemployment rises 0.5 percentage points above its 12-month low, the country is already in recession. And we are right at that threshold. Once layoffs begin, They cascade. Companies cut staff unemployed, consumers spend less, demand falls, more companies cut staff, housing defaults, increase bank losses, increase credit, tightens, unemployment rises further. In recession psychology, fear becomes strategy. The moment policymakers lose control. The Federal Reserve, for decades the omnipotent guardian of the U.S. economy, faces an impossible trilemma. Cut interest rates. Inflation reignites print money. Currency weakens. Inflation explodes, do nothing. Economy collapses into depression. There is no painless path. In 2008, the Fed had an escape hatch. In 2025, it has none. And this is where the collapse becomes generational. Because when both the financial system and the policy tools fail at the same time, the crash doesn't last months. It lasts decades, just like Japan after 1990. Just like the US after 1929. Entire generations never recover, and millions of Americans, retirees, homeowners, workers, students, will face losses they cannot rebuild in a single lifetime. The stage is fully set. Every bubble is inflated. Every indicator is flashing red. Every safety net is stretched thin. Every domino is positioned. Only one thing is missing, the spark. And when the spark comes, it spreads faster than any previous era because the entire system is interconnected, automated, and leveraged. In Part 4, we will walk through the full timeline of the collapse, the mathematical projections of losses, and why 2025-2026 will rewrite the economic map of the world. This is where the story turns from warning to impact. Crashes do not end when markets fall. They end when societies change. Every major financial collapse, 1929, 1973, 1997, 2008, reshaped the world that followed. But none of them combined multiple asset collapses with sovereign debt exhaustion and global fragmentation. 2025-2026 is different because it doesn't just break markets. It breaks the architecture underneath them. To understand the scale of the coming crisis, we must now walk through the full cascade, step by step, from the trigger to the collapse, to the world that rises in its ashes. This is the part most people fear, but it's also the part most people need to see with clarity. The cascade, how the collapse unfolds, phase 1. The market breaks, month 0 to 1. The trigger, an earnings miss, a bank failure, a geopolitical flare-up, sparks a sell-off in the Magnificent Seven. Nvidia drops 15%, Apple, Microsoft, Amazon, Google, Meta, Tesla fall in sympathy, S&P 500 drops 6 to 9%. Algorithms accelerate selling. Margin calls begin. Retail panic hits social media in real time. Institutional risk systems activate. What took weeks in 1929 takes days in 2025. By the end of the first month, S&P down 25-30%, NASDAQ down 35-40%, Magnificent Seven down 40-60%. Passive investors watching their 401k balances crash log in, stunned. But this is only the beginning. Phase 2, the bond crisis, month 1 to 3. As stocks crash, investors pour into government bonds, but the government must issue record levels of new debt simultaneously. The collision creates chaos. Treasury yields rise instead of fall, mortgage rates jump, refinancing collapses, bond prices crash 20-30%. This has never happened in a modern financial system. Bond portfolios owned by banks, pension funds, and insurance companies bleed losses they cannot hedge. The sovereign debt doom loop has begun. Phase 3, the housing freeze, month 2 to 6. Higher rates shut down the housing market. Buyers disappear. Sellers refuse to cut prices. Listings stagnate. Price cuts begin, then the flood. Markets like Austin, Phoenix, Boise, and parts of California fall 20-30% within months. Over the next year, 40-50% declines become reality. Recent buyers, millions of them, go underwater. This is 2008 and fast forward. Phase 4, commercial real estate detonates. Month 3 to 12. $2 trillion in commercial mortgages come due. Refinancing at 8% is impossible. Defaults explode. Owners walk away, lenders seize buildings. Buildings are worth 40-60% less. Bank capital evaporates, regional banks fail one by one. The failures of Silicon Valley Bank and First Republic look tame in comparison. FDIC runs out of money within weeks. The government must print trillions to cover deposits. Printing triggers inflation. Inflation triggers distrust. Distrust triggers political panic. The system is now in freefall. Phase 5, labor market collapse, month 412. Unemployment rises from 4% to 7-8% in 3 months, 10% in 6 months, 12 to 15% within a year. Tech layoffs hit first. Finance follows. Retail collapses. Small businesses die in silence. Young graduates in 2026-2027 face the bleakest job market since 1982. Millions fall behind economically before their lives even begin. An entire generation loses its trajectory. Phase 6, the currency crisis, month 6 to 18. The Federal Reserve faces a nightmare trilemma. Cut rates, risk hyperinflation, print money, crush dollar credibility, hold steady, deepen depression. There is no right answer. As unemployment and defaults surge, political pressure forces the Fed to act. They cut rates. They announce quantitative easing to stabilize markets. And instantly, the dollar weakens, inflation rekindles, import prices surge, fuel costs rise, consumer confidence collapses. The U.S. enters a state not seen since the 1970s. Stagflation, recession plus inflation at the same time. A trap with no easy exit. The numbers, what the crash actually looks like, based on the mathematics of valuation reversion, debt load, and historical analogs. Here is the projected impact. Stocks, S&P 500, 65% to 80% NASDAQ, 70% to 85% Magnificent, 60% to 90% bonds, Treasury bonds, 35% to 50% corporate bonds, 40% to 60% junk bonds, 60% to 80% real estate, residential, 40% to 60% commercial, 50% to 70% unemployment, 12-15% recovery timeline. Not 5 years, like 2008. Not 7 years, like 1970s. But 10-20 years, if recovery even returns to old highs at all. Japan's stock market took 34 years to recover after its 1990 bubble burst. The U.S. is on a similar trajectory. The human toll, where the pain is felt. Retirement accounts, average Americans watch their life savings fall 60 to 70%. A nest egg of $600,000 becomes $200,000. People delay retirement by 10-15 years. Some never retire. Homeowners' millions become underwater. Selling becomes impossible. Relocation becomes impossible. Upward mobility freezes. Young families' debt rises. Income falls. Childcare becomes unaffordable. Life milestones, marriage, home ownership, children, get postponed. Small businesses crushed by lack of credit, crushed by weak demand, crushed by rising costs. Many never reopen. Social safety nets overwhelmed at the moment they are most needed. This is where economic crisis becomes social crisis. Political consequences. The age of extremes. The 1930s taught the world a brutal lesson. Economic desperation feeds political extremism. Weimar Germany collapsed into authoritarianism. Extremist parties rose across Europe. Democracies weakened under pressure. Populations became radicalized. America is not immune. When savings evaporate, when unemployment spreads, when inequality explodes, when trust collapses, people search for someone to blame and someone who promises extreme solutions. The political shockwaves of 2020-2030 will shape the next generation. Why 2025 is worse than 1929, plus 2008 combined. Because it blends the worst ingredients of both. From 1929, extreme stock valuations, extreme leverage, extreme concentration, technological euphoria, inequality at dangerous levels. From 2008, a housing bubble, a fragile banking sector, excessive consumer debt, and something new, a sovereign debt crisis layered on top of everything else. No country in history has simultaneously faced stock bubble, real estate, bubble bond, bubble exhausted central bank capacity, exhausted fiscal capacity, global geopolitical fragmentation. This is why historians call 2025-2026 the everything collapse. Not because one sector crashes, but because every sector crashes together in the usual lifelines, cheap money, bailouts, global cooperation no longer exist. The world has not seen this combination. Not in 1929, not in 2008, not ever. The final warning and the final truth for decades, Americans believed the system would always recover, because it always did. But systems do not fail because of one big shock. They fail from the accumulation of small imbalances ignored for too long. 2025 is not a prophecy. It is the inevitable result of overvalued markets, unpayable debt, fragile banks, exhausted policy tools, global instability, and mathematical certainty. This is not fear-mongering. This is pattern recognition. The same patterns that preceded 1929 and 2008 are here again, only more extreme, more synchronized, and more global. The crash is coming. The only question left is simple. Will you be prepared when it arrives?